Semiconductor's 9% decline compels business leaders to secure AI value creation and strengthen investment strategy. Global semiconductor stocks have fallen about 9% since late June, and you should recognize this isn't just market noise, because investors are questioning whether AI spending still creates proportional shareholder value. Nvidia shares recently slipped around 2%, reminding you that even dominant AI leaders face valuation pressure when markets begin demanding measurable financial returns instead of future growth promises. The Philadelphia Semiconductor Index has corrected roughly 20% from its recent peak, signaling you should prepare for more disciplined AI investment decisions across global capital markets. China's Kimi K3 open-weight AI model has changed investor conversations, and you should understand that software innovation now challenges assumptions about endless hardware demand and infrastructure expansion. For nearly 2 years, semiconductor growth depended on larger AI models requiring bigger GPU clusters, but you now face a market asking whether software efficiency can reduce hardware requirements. Nvidia became the industry's biggest winner because its data center GPUs dominated AI training and inference, yet you should expect investors to demand stronger commercial outcomes going forward. Institutional investors are watching 3 interconnected risks, and you should appreciate that hyperscaler spending, open-weight AI competition, and premium semiconductor valuations are now colliding simultaneously. Hyperscale cloud providers have committed hundreds of billions of dollars to AI infrastructure, meaning you can no longer ignore return on invested capital when evaluating future technology investments. Open-weight AI models are improving rapidly, and you should expect growing software competition to reshape how enterprises justify expensive semiconductor purchases and infrastructure expansion over coming years. Semiconductor valuations already reflected highly optimistic demand assumptions, so you should understand why even modest expectation changes triggered meaningful market corrections across leading AI hardware companies. Investors increasingly question whether the near-trillion-dollar AI spending cycle can continue unchanged, and you should prepare for stricter financial scrutiny despite continued long-term AI demand. AI demand remains strong because enterprise digital transformation continues, but you should recognize that markets now reward productivity, utilization, efficiency, and monetization instead of infrastructure announcements alone. L-Impact Solutions believes this semiconductor correction reflects structural repricing rather than temporary panic, and you should view capital efficiency as today's most valuable competitive advantage. Since late June, semiconductor stocks dropped about 9%, Nvidia declined roughly 2 to 3.5%, and its valuation slipped below $5 trillion, showing you how quickly market sentiment can change. Apple briefly reclaimed the world's highest market valuation, reminding you that leadership shifts rapidly whenever investors prioritize earnings quality over ambitious AI spending narratives. You should pay close attention because hyperscalers are expected to invest around $650 to $673 billion in AI infrastructure during 2026, making capital productivity more important than spending scale. Bridgewater estimates Alphabet, Amazon, Microsoft, and Meta alone will invest about $650 billion, and you should ask whether enterprise monetization can realistically keep pace. UBS expects hyperscaler capital expenditure growth to slow from 76% in 2026 to 25% in 2027 and only 6% by 2028, so you should prepare for moderation. You should recognize that infrastructure spending cannot indefinitely outpace commercial AI adoption because financial markets eventually reward sustainable earnings instead of aggressive expansion. AI hardware leadership remains valuable, but you should expect future valuations to depend increasingly on free cash flow, operating margins, and return on invested capital. A handful of companies including Nvidia, Broadcom, TSMC, AMD, and ASML generated outsized technology returns, so you should understand why portfolio concentration risk is rising. Semiconductor-focused funds attracted around $10 billion through May 2026, yet you should notice institutional investors gradually rotating towards cybersecurity, healthcare technology, and enterprise software. You should avoid concentrating your investments in one AI theme because diversified exposure can reduce valuation risk as semiconductor market expectations continue evolving. L-Impact Solutions believes many corporate boards still emphasize GPU procurement instead of measuring financial performance, and you should avoid making the same governance mistake. You should target infrastructure utilization above 80%, optimize inference costs, improve deployment velocity, and achieve investment payback within 24 to 36 months before expanding AI budgets further. AI investments should be governed using ROIC, EVA, discounted cash flow, and stress testing because you need financial discipline alongside technological ambition. You should define measurable business outcomes before purchasing AI hardware, including revenue growth, productivity gains, fraud reduction, manufacturing efficiency, and stronger customer retention. Every AI initiative should exceed your corporate weighted average cost of capital, WACC. Ensuring investments create genuine shareholder value instead of impressive technology headlines. With hyperscaler spending reaching $650 to $673 billion during 2026, you should conduct quarterly reviews covering GPU utilization, infrastructure occupancy, EBITDA impact, and operating cash flow contribution. If AI projects consistently miss predefined milestones, you should restructure workloads, optimize deployment, or reduce investments before approving additional capital commitments. You should diversify beyond one GPU vendor, one cloud provider, or one foundation model because excessive dependence increases pricing, supply chain, and technology obsolescence risks. Hybrid cloud infrastructure, proprietary models, open-weight architectures, edge AI, and multiple semiconductor suppliers can help you lower operating costs while strengthening procurement flexibility. Semiconductor companies should diversify beyond frontier AI training because you can unlock resilient growth through healthcare, robotics, manufacturing, cybersecurity, autonomous mobility, and enterprise inference. You should recognize that broader enterprise demand creates more stable recurring revenue than relying exclusively on hyperscale cloud providers for long-term semiconductor growth. Institutional investors should stress test portfolios against 20 to 30% slower hyperscaler spending growth because market optimism alone cannot protect long-term investment performance. You should also evaluate scenarios involving lower GPU pricing, software efficiency improvements, geopolitical restrictions, higher financing costs, and expanding open-weight AI competition. Companies combining recurring software income, diversified revenue, disciplined capital allocation, and consistent free cash flow are more likely to outperform during AI market maturation. Future AI investment cycles should prioritize measurable productivity before approving infrastructure expansion, ensuring you build sustainable economic value instead of temporary market excitement. L-Impact Solutions recommends board-level AI governance committees, and you should oversee cybersecurity, ESG, regulatory compliance, financial performance, and operational resilience together. You should review AI investments quarterly by measuring ROI, infrastructure utilization, commercial adoption, and operating cash flow rather than focusing only on technical benchmarks. AI innovation cycles now evolve within months rather than years, meaning you should reassess technology priorities far more frequently than traditional annual planning cycles. Instead of rigid annual roadmaps, you should implement rolling strategic reviews every 90 days to rapidly reallocate capital as competitive conditions evolve. Modern semiconductor manufacturing depends on advanced lithography, high-bandwidth memory, packaging capacity, specialty chemicals, rare earth materials, and reliable energy, so you should strengthen supply chain resilience. You should diversify semiconductor sourcing, maintain strategic inventory buffers covering 3 to 6 months, and perform annual geopolitical stress tests to minimize operational disruption. Financial resilience matters because organizations investing hundreds of millions or billions in AI infrastructure cannot afford weak liquidity planning or excessive leverage. You should maintain liquidity reserves covering at least 12 months of planned capital expenditure before committing to large-scale AI infrastructure expansion. Infrastructure expansion should follow measurable improvements in utilization, customer adoption, revenue generation, and operating cash flow instead of speculative future expectations. Sustainable AI leadership depends less on semiconductor volume and more on your talent, proprietary data, governance quality, cybersecurity maturity, and responsible AI implementation. Hardware remains a strategic enabler, but you should remember that long-term competitive advantage increasingly comes from converting infrastructure into measurable productivity and durable earnings growth. L-Impact Solutions concludes the recent 9% semiconductor decline and NVIDIA's 2 to 3% weakness reflect a market-rewarding financial discipline rather than infrastructure expansion alone. Global AI spending is moving toward $500 billion annually, and you should ensure every technology investment delivers measurable commercial value before scaling infrastructure further. As hyperscaler spending growth slows from 76% to 25% and then 6%, you should expect semiconductor demand to depend increasingly on enterprise productivity. You should strengthen AI governance through quarterly capital reviews, infrastructure utilization targets above 80%, diversified technology portfolios, and scenario-based financial stress testing. Businesses converting AI infrastructure into revenue growth, operating margin expansion, productivity improvements, and sustainable free cash flow will likely outperform competitors throughout the next AI cycle. Your biggest competitive advantage won't come from spending the most on AI, but from generating the highest economic return on every invested dollar, exactly as L-Impact Solutions emphasizes. Is your AI strategy creating value or just burning capital? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.